Hello, everybody. Hello, and welcome to Private Equity Rundown. I'm Bill, the company's expert. Thank you for joining me today. Happy Friday to everyone. For me, it's been a bit of a hectic day so far. That's why I've had to push this back by an hour, but I'm here now, and hopefully you are too. So yes, this is the weekly live stream where it's still technically experimental, where I talk about private equity because, quite frankly, I just like the subject. And technically, it still does tie into the whole kind of theme of my channel because my channel is about basically what to do with your life as a livelihood and all this kind of thing. So technically, this does apply. And these principles are kind of cool. They're universal. You could use them in your life in terms of, your career and things like this, even if you're not in private equity. So that's why I wanted to cover it. Helicopter is here. Says happy Friday. Happy Friday to you, Helicopter. And Alex Kwok is here. Alex says, hey, how are you, bro? I'm doing fine, bro. Thank you for being here. So this is episode number 16 of Private Equity Rundown. And this is called Exit, Sell, Return on Investment, Part 2. Because quite frankly, this topic that I was covering last week, it was just too much to do in one day, one stream, so it kind of spilled over. So I wanted to do a part 2, so that's what we're going to do today. And what we've been doing is we've been covering the 7 steps of the private equity process. If you may recall, there are 7 steps, and we were doing 1 step per episode for the last several episodes. So just to give you a brief recap, the 7 steps were target identification, we did an episode on that. Due diligence, an episode on that. Valuation, another episode. Negotiation, another episode. Acquisition, that's where the private equity company buys the target firm, right? And the next one was post-acquisition improvements. This is my favorite part of the process by far, and my core competency. And then you get this, the final stage, which is exit, sell, and ROI. Because basically, if you're not familiar, private equity is, it's an area of financial services where you get businesses that buy other businesses. And the idea is that they, in theory, they essentially flip the business. They buy the company, they do stuff to it, and then you wait around 5 years, something like that, give or take, and then you sell the business. And just like flipping a house, you sell it for more than you bought it for. That's the idea, right? So that's what private equity is. And when you talk about this stuff, you're covering different aspects of finance, different aspects of business. And it does sort of cover what we see a lot in the real world, because private equity, for better or worse, is everywhere. And you see a company, they have their logo, their name, right? And you don't really know who owns it behind the scenes, right? And these companies are being bought and sold continually. So that's what we're covering. Now, we were covering the last step, exit, sell. The first time, last week, the first episode where we talked about this, we covered things like preparations for sale. Okay, so what companies do when they're preparing to sell. We talked about identifying buyers. Okay, that's another kind of key aspect of selling. We talked about marketing the business. So you're promoting this among your potential sellers, your potential clients, right? And that's what we covered last time. There's still more to the stage that we're going to cover today, which is, first of all, negotiation. We're going to talk about negotiation, and we're going to talk about closing the deal. And that's pretty much the end of this process. Before we really get started, though, a shout out to my YouTube channel members. See that right there? Right there? Yes, join my channel. Membership has the privileges. So a shout out to all my YouTube channel members, my Patreons, because I am on Patreon too. My super thanks donors, I've had a few of those, and that's awesome to get those. I make sure I answer your question fully and completely to the best of my ability. And I'm not pressured by time constraints in a chat or in a live stream. And also to you, my participants, thank you for being here. Hopefully you're getting something out of this. And I'm going to do my sort of little monologue/lesson, and then we're going to open it up for questions. If you have a question about what I'm talking about, feel free to ask it as we go. Okay, so all the Alex Kwaks and the helicopters of the world, feel free to jump in. Okay, so here we go. We're talking about exit and selling. Let's talk about negotiation. We've set everything up. Okay, we've identified buyers. We've promoted the business. Now we're engaged in talks with one or more of those potential buyers. Now we're going to negotiate with them. Helicopter says, I learned something new from every one of your videos. You rock. Well, thank you very much, Helicopter. That's high praise indeed. And I talk about quite an eclectic sort of array of different things on here. So that's awesome. You know, if you're young, learn as much about different things as you can, because when you get a bit older, then you can start putting them together and building things upon them, right? I'm a generalist, so I encourage that. Okay, so negotiation. What do you do in negotiation in terms of private equity? Well, there's kind of two halves of this. One is the price, and the other one is the terms. Okay, so let's talk about these. So the price, everybody focuses on the price, but it's really not the full story. Okay, just sort of the cliff notes of how this works. When you're talking about the price for a company or a business unit, right? There's a couple of principles that they use in private equity. One is the enterprise value. Okay, so EV, enterprise value, and that's essentially the total value of the business. Okay, so what they do is it's based off EBITDA. I don't know if there's any accountant types here, but if you know basic accounting, you probably have heard of EBITDA. Earnings before interest, taxes, depreciation, and amortization, if I recall correctly. So enterprise value is the total value of the business before debt and cash adjustments, right? So that's the value of it. Now, if it's taken out a bunch of debt, obviously that affects its value. If it has a bunch of cash sitting in its bank accounts, obviously that affects its value. But essentially, you're getting the value of the business itself, what it's actually worth. Okay, that's enterprise value. Okay, now just to make things slightly complicated, when you are negotiating the price for buying the business or selling the business to somebody else, what the transaction price is, you're not actually paying the enterprise value, okay? Because the way it works is what the seller actually receives from the buyer is called the equity value, okay? So the way this, in order to understand these things, you have to understand what the process is. So the amount that the seller actually receives from the buyer is the equity value, okay, which is the enterprise value minus debt, okay, and this is because the buyer basically uses part of the enterprise value to pay off debt, okay. So usually the way it works is when the business changes hands, the target firm changes hands, okay, you're going to pay off the debt, right? And so the buyer uses part of the equity value, the enterprise value, to pay off the debt, and whatever is left over after doing this, after subtracting the debt, is equity, okay? And that goes to the seller. So that's why essentially what the seller gets from the buyer is the equity value, okay? And the only reason you have that is because a lot of these target firms that are being sold by the private equity company, they've got a lot of debt. One of the things that private equity firms do is they leverage these companies right up. They take out as much debt as they possibly can. Never mind about why. We kind of covered that previously. It's a whole long story, but that's what they do. And so you're selling something that it is in debt to a lot of places, you know. So obviously that affects the purchase price, right? So that's what slightly complicates it. So the only thing you got to remember is that there's something called the enterprise value, which is the total value of the business. But because there's all this debt involved, the actual value that the transaction that is for, the value of the transaction, is for the equity value, which is a small subset of the enterprise value. Okay, clear as mud? Man, I am not doing a great job of explaining this, but hopefully you get that. This is the thing. This is the nature of this stuff. Now, let's talk about the terms. The terms are a little more complicated and interesting than simply a number, like the amount of the transaction. Okay? The terms are where the real negotiation happens. Okay? It's not just what you're going to do, but how and when. Okay? Those matter a lot, right? For example, let's pretend that you were selling something, okay, to a stranger. And the terms were that, they are going to pay you the full amount upfront, right? And then you hand over the thing. Okay, now that's simple. The problem is that, if you're the one buying it and you're told you have to hand over the full price in advance before we give you the thing, are you going to trust that they're not going to pull a fast one on you? No, there's plenty of opportunities for them to take the money and run, and what they give you ends up being something that you didn't agree to, or it ends up being really crappy, not what you were expecting, right? So if you change the terms and you said, like, okay, listen, you hand over the thing now, and I will pay you the full price in 1 year, right? Then it swings the opposite way, right? Now the seller is not really into that because, there's every opportunity for the buyer to take the money and run. They receive the thing and then they just decide not to pay. You can't locate them in a year, right? Or you can, but then they come up with an excuse saying, well, it didn't really work out. This thing wasn't what I expected, so I'm not going to pay. So somewhere between the two extremes, if you figure out the terms, right, then the two parties trust each other and they feel more confident that they're not going to be swindled, right? Now, the traditional way you did this was to say half up front and half when it's over, right? And that way there's sort of equal risk among the two parties. The buyer hands over 50% of the total price up front. And the seller is happy about that, obviously. But then after the seller, completes the transaction and presumably the buyer approves it and they inspect what they're getting and all this, then the onus is on them to then pay the other 50%, right? So it spreads the risk equally between the two parties, right? And therefore, the chances of these deals going bad goes down quite a bit, right? So same thing here. So the terms are really what it's all about, right? So this is where the real negotiation happens. It's not about what you do. It's about how you do it and when you do it and all this kind of thing. Let's introduce a couple of things here. There's something called an equity rollover. That's where the seller, the private equity firm, is selling the target business, okay? And the buyer buys something like 90% of it. They don't buy the entire thing outright. The seller still retains 10% ownership in the thing that they're selling. And the reason for that is trust. Excuse me. I have a little bit of a chest thing, so I'm muscling through this. So the equity rollover. So the seller often keeps a minority stake in the business post-sale. Okay, that's a common thing. And it's for the buyer to feel comfortable that the seller is not going to pull a fast one on them. Because if they are selling a piece of crap that turns out to be a lemon or something, they still own part of the lemon, right? So there's less incentive for them to do that. Yeah, and like I said, this is because it aligns the interests and signals confidence to the buyer. Excuse me, again. Okay, so that's one kind of thing that's in place as a standard thing in these deals, okay, the equity rollover, right? There's yet another sort of thing that's a standard thing in there, and that's escrow. This is a completely different thing. This is where a percentage of the sale price, usually between 5 and 10%, somewhere in there, okay, it's withheld in a separate account for a couple of years, 1 to 2 years usually, And that's released by a third party. So a third party has to approve the releasing of those funds to complete that transaction after 1 or 2 years. Okay, so you can't have major breaches or any kind of issues like that. Okay, so this to cover unexpected liabilities or breaches. So, I'm going to sell you a business. What I didn't tell you was that that business is being sued by 25 different companies for all kinds of major things, and they're probably going to win. I forgot to mention that, right? And I buried that so you couldn't find it on your due diligence. So you have the escrow in the final deal where, if there is something like that comes to light, well, at least the seller doesn't get all their money, right? So that's the idea. Okay, so that's like a second separate insurance policy, shall we say. Okay, a third thing that's written into these agreements, and just by virtue of there being lawyers involved in the process, are warranties and representations. So this is like a third separate thing that's like a checks and balances, if you like my grammar. Okay, so a legal promise about the business. Okay, it's where you put into the contract statements of fact, right? So, for example, you could say all taxes are paid, right? That's written into the agreement, right? And it's a statement of fact. And basically, you're asserting that that's true. So if it turns out that that's actually false, now you've got a legal claim on your hands, right? You could essentially sue somebody for it. So it's like legal promises about the business, okay? And if these are false, the buyer can seek compensation. So if you're selling a business and you say there are no open lawsuits against this business, something like that, right? And it turns out to be false, then there's a legal recourse. Okay? Now, the way this is handled, now this is kind of where I don't know a ton about this personally, but the way this is handled is you have something called representations and warranty insurance that you can buy from a third party. Okay? And basically, it's almost like, what doctors have? They have like malpractice insurance and things like this, where if there's any kind of dispute, the insurance company will cover that, right? That's the idea. So if you get sued for something that, happened, right? Maybe it wasn't intentional, but it did happen. You have insurance for that. They will cover all the legal costs of that. And I think it works different ways. Either they'll pay all your legal costs or they'll deal with the actual claim directly. Okay? They won't just pay the lawyers and have you go to court for it. They'll actually settle it directly. Okay, so there's different ways of handling it. I'm not a lawyer. I'm not an expert on that, but I know you can get this. Okay, so basically the buyer or the seller can buy this type of insurance, and that covers, any kind of breach of a representation or warranty, like a legal statement in the agreement, if it's breached. Okay. And what's the purpose of this? It exists once again to mitigate risk. This can shift the risk off the seller, and it's not actually built into the contract. Like you don't have the representation and warranty insurance built into the contract, but it's referenced in the contract because all the statements are in the contract. Okay, so those are basically three separate mechanisms that are built into these agreements that amplify the trust between the buyer and the seller, so that you can conduct these transactions and you can trust that it will go according to expectations, at least when it comes to the transaction itself and what you're actually buying. That's the idea. So those are examples of some of the terms in these types of agreements. Okay, so you got the price and you got the terms. So that's kind of a bit about those, how those work. That's the negotiation phase. And that brings us to the final part of this transaction, okay? And that is closing the deal. So that's where you sign the final agreements. So you have an agreement, okay? And it's usually, the term that I've heard is called the purchase and sale agreement. Now it's abbreviated, I believe, I could be wrong about this, it's abbreviated SPA. So sales and purchase agreement, even though it's called the purchase and sale agreement. Maybe I just had bad people that were that were doing this and they used the wrong terms, but that's what I've seen. Okay, and the buyer's legal counsel drafts it. Okay, so that's who creates this agreement, at least the first draft, and then the two parties kick it around after that. Okay, so the seller's lawyers review it. Okay, you kind of amend it and annotate it as necessary. Okay, and then you sign it. And when the transaction is made official, okay, that's called the closing. Now, I understand that this works differently in different countries. Where I am in Canada, it's not registered with any official body. You know, when you just have an agreement like this, you don't have to register the agreement with any body. But there are things in it that have to be registered with other parties. Like, for example, if you have a transfer of shares, okay, you're going to have some kind of company's office or corporate registry, something like that you have to register that with. I don't know all the technical details, and that varies by country. I know in the US it's slightly different. Real estate. If real estate changes hands as part of this agreement, somebody's buying the company, then that has to be registered with the land titles office and all this kind of stuff. And there's also an element of regulatory approval, right? Depending on the nature of the deal, you might not be able to just go ahead and make an agreement because there are different government entities that have to approve it. Like, for example, I don't know, if your country is at war with another country, it would be weird for people from that country to buy one of the companies in your country. You know what I'm saying? Like, so it would have to be approved by the government. In Canada, there's something called the Competition Bureau. I mean, if there's financial transactions, you have to register with like Investment Canada. All the stuff to do with securities and all this. I don't know all the ins and outs, but it's going to vary by country and even by region. I think in the US, some of the stuff might be handled on state by state basis at the state level. So I'm not sure. But lawyers deal with that stuff, that do this and that are licensed. So they know all the ins and outs of this. So wherever you are, they should be able to advise you on exactly where it has to be registered if you need to know. Well, you do need to know, but, all you have to make sure is that they're doing it all properly. So there you go. And that's the end of the transaction. Finally, after 7 episodes, actually 8 episodes, because we're lengthening this into 2 episodes. That's it. That's the end of the deal. It's all signed, sealed, and delivered, and that's basically how it works. Now, I was going to talk about something, return on investment. I'm going to leave that for another episode. I just want to say this. I've taught this in business school where, you talk about ROI, return on investment, and the standard calculation for ROI is in the context of something that you buy and then later you sell, right? So think of in terms of you're buying shares or something, you're buying stocks on the stock market, and, you buy a stock, you hold on to it for a certain amount of time, and then you sell it, right? Presumably between those 2 times, when you buy it and then later when you sell it, the value of the stock changes. Its price goes up or down, hopefully up, right? There might be other things happening during that time. You could be getting dividends. It would pay out every 6 months or every quarter of you holding that stock. It pays you a few cents, in dividends, right? So basically, you have a buy price, you have a sell price, you might have disbursements like dividends, right? And then you can calculate the return on investment, right? The ROI. Now, in the case of a business, okay, we're talking about private equity. You are buying and selling, but a lot of ways you look at businesses, it's not usually in terms of selling the business. For example, if you buy a coffee shop, right? You buy a Tim Hortons or a McDonald's or any other fast food or any other franchise, right? You buy it, you pay a lot of money for it initially. Okay, so you become a franchisee or whatever. And then it's going to make you a certain amount of money every year thereafter, right? Now, you should be able to calculate the ROI, but you're not selling the business. That's the key thing. It's not like buying shares on the stock market where you buy it, but then later sell it and calculate a return on investment. In this case, you're buying the business and it's making you money, like it's giving you disbursements, right? Every year, but you're not selling it. You're holding on to it, but you're still wanting to calculate your return on investment. Let's say you bought your franchise 10 years ago, and you're trying to figure out your return on investment. If it cost this much money in this year, and every year it's made you this much money, these amounts every year, what's the return on investment? You can do that calculation, but it's a slightly different calculation to the standard thing that everybody thinks of when it comes to return on investment, because they're applying it to something that you then sell, right? So anyway, I wanted to go into this. I wanted to give you the math behind the calculations, but we're not going to do that today. It's a little too much. So we'll talk about it next week. And then what I'd like is ideally to hear from you guys as to what topics you're interested in. Some people expressed interest in, if you're an employee in a business that's acquired by a private equity company, what does this mean for you? What can you expect to happen? That kind of thing. I think that's a great topic. I'm going to definitely be going into that in the upcoming episodes. But also, what else are you interested in? You see, you can use some of these principles, what they do in private equity, to create interesting new options for you in your career. So, for example, if you end up being a manager of a business, maybe you do a management buyout. Maybe you combine with other managers, you pool your money, and then you buy the company. So you're not only the managers running the company, but all of you collectively own the company, right? That's called a management buyout. That's something that's been done quite often. And I think that's really, really cool, because essentially you are forming your own private equity company, and then you are owning the business that you run. So not only do you get your salary or your pay, right, your compensation you normally get as a manager, but you also get the profits of the business carved up and distributed amongst you, right, if you all together own it. So that makes some very interesting possibilities. And you can bring this down on the small scale for other things that you're doing too. So that's one of the reasons how you can apply some of these principles. Anyway, if you want to learn about some of the concepts that I have been mentioning here, check out that course. That's my $100 MBA course. For what it's worth, I have an MBA, and for what it's worth, I was a CEO. And what I did is I created that course for people who want to learn business, but yet they don't want to take 2 years off, go back to school, pay 5 or 6 figures for it to get a real MBA. They want the knowledge, but they don't necessarily want the whole dollar price disruption to their lives and to your schedule. So if that's you, check out that course. You can learn anything you would learn in a brick and mortar MBA with that course. Certainly an online MBA, because it's a self-study thing. So I've also done videos, or one video in particular that's a FAQ type video that describes that course. So in the interest of transparency, you can learn all about how the course works, what you get, all that kind of thing. So you are fully informed if you are interested in that kind of thing. A lot of people that have taken that course are entrepreneur types. They want to learn business, but they don't necessarily want to go back and get an MBA with the expense and with the time scale. So this is an alternative. Another class of people that have bought that course are people that are wanting to get an MBA, but they want to get a head start on it. They want to get a little bit of an edge and do well. And this allows you to do that. You can see all the material ahead of time. You can bone up on it. You can learn it in advance. And then when you get to the course or the MBA program, that you're doing in a university or something, then you have an advantage because you already know the material. So check that out. $100, not 100,000. Somebody responded to me thinking it was 100,000. It's like, no, it's $100. It's like nothing. So especially if you're deciding whether you want to go back and take a real MBA or not, you're willing to drop like 5 figures on it or something. This is nothing compared to that. So anyway, if you're interested in learning business, that's the best bang for the buck. You're getting the same source material that they use in the best universities in the world, like in Harvard Business School in their MBA program. You're using the same books and things like that. So check that out. I'd like to open it up for questions. If there's anyone who has any questions about this stuff, about private equity, business, finance, that kind of thing. Yeah, I have an MBA. I took an MBA with a specialization in finance, like when? 10 years ago, something like that? More than 10 years ago, actually. Yeah, so for what that's worth, interesting stuff, finance. Interesting perspective. What you learn in business is that there are different topics within the world of business, right? There's things like marketing, operations, finance, accounting, HR, organizational theory, quality, project management, IT. There's like all different areas. And they all have a different perspective of looking at, a real world business event, right? So if you have a business problem or a concept, you will have all these different ways of approaching it, right? An accountant will come to a different conclusion about what needs to be done than a salesperson. And an operations person will have yet a different perspective than those first two, and so on, right? And it's only by really getting a shared perspective of all these different areas do you really see the full picture. And you can look at an event, you can look at a problem or a question and really understand what's the best thing to do here. Because sometimes one approach will win out, sometimes another one will win out. Maybe the right thing to do here is the accounting perspective in the short term, but the marketing perspective in the long term, or vice versa. It gets rather complex. So that's what an MBA does. It teaches you all the different perspectives by studying all these different areas. And if you only know one area, that's kind of dangerous because you sort of see everything in those terms. And that's bad because it gives you a false sense of expertise. You can look at any problem. Like for example, I've seen many people do this from different areas, but I've seen what most comes to mind is accountants look at every business problem from an accounting point of view. And it's like, no, no. And they are pretty damn ineffective at running a lot of types of businesses. If you just predominantly think in terms of accounting all the time, So you get something like an MBA, they teach you everything. So if you're strong in one or two areas already, that's great, but you need to fill in those other areas, and that will give you a much better, more accurate, objective view of the world and everything you see in it. Pearl says, "Hi Bill, thank you so much for all your advice. I've been watching you for months and it helped a lot." Thank you very much, Pearl. That's very nice to hear. Pearl says, "I just got an offer for my dream job and I signed the form yesterday." Well, congratulations. That's great. I'm glad that that's working out for you. And onwards and upwards, now that you at least have a job that's hopefully working for you, life goes on, the learning continues, and you continue your rise. That's usually everybody's progression. I'm not sure how old you are, Pearl, but if you're younger, you're just starting out, like it's a progression, right? Some people end up working in companies, they end up running the company, and then they jump into this kind of world that I've been talking about today, where if you own a company, it's doing well, you buy other companies, you expand it, things like this. Some people end up doing that kind of thing. Other people, they take what they learn and they go a different path, and that's perfectly fine. On Mondays, I do a live stream about entrepreneurship. And entrepreneurship is an alternate way for a lot of people to go, and a lot of people do take that path. Instead of working as an employee their whole lives, they learn about going their own way, where you don't need to work through an agent like an employer for you to make money. You make money directly, and some people do it that way. You know what I mean? And sometimes these worlds both meet. You start out as an employee, you learn a business by seeing it from the inside. You then have your own ideas about, how it should be done or what could be done. So you kind of leave to do something very similar, but, something that adds on or something that's done your way. You can use your original employer as your first customer, there's all kinds of different ways of doing it, right? Some people get into the world of investing. And I mean, in a sense, it's their job, it's their vocation, but it does require a lot of work. You have to make very, very good and shrewd decisions with what you invest in, and you need to investigate it. You need to understand what you're getting into and know what to do your due diligence on, and know what needs to be there for you to believe it's a good investment. It's about information hoarding too. You know something and you don't want it widely known because it gives you an advantage, or at least you believe it does. So there's many different paths you can go, and you can build on it. But my point is that for a lot of people, they start when they're young, just getting a job, seeing how something is done and being on the inside of it, and it can go out from there, depending on your goals and your personality and, what appeals to you, Pearl says, yes, this is my first full-time position. Well, congratulations, Pearl. I wish you every success, and I will still be here. I imagine you will no longer need any more advice as to how to get a job, but I will still be here to talk about other and more advanced things. At least I hope I will be. And I hope you'll come back and see me sometime. And that's probably a good place to end for today, for this episode of Private Equity Rundown. You guys are awesome. Thank you for listening to my long-winded, rambling stream of consciousness kind of thing today. I intend to continue this stream, and we'll hopefully I'll be doing it in a more organized way going forward. But I think next week we'll be talking about ROI, doing the calculation, and talking about the different ways of looking at it. And that might give you some ideas of things you can do when it comes to businesses and things like that. Either you could start your own business, or you could buy a business, or you could do it on the side, So there you go. Anyway, you guys are awesome. I will see you in a week. I actually have another live stream in about 20 minutes on this channel where we're going to be talking about job search. It'll be an episode of Honest HR Nitrous where we talk about the gritty reality of job search. So that's coming up in 20 minutes. Other than that, you guys take care. Have yourselves a great weekend, and I will see you soon.